Good morning. Thank you to everybody for joining us today. I am Karen Weiskopf, Vice President of Marketing at First Long Island Investors. And first and foremost, we hope everybody is in good health and enjoying the start of fall. We have a great agenda planned for you today, and I'm joined by some of the key members from our investment committee. First, we'll have Robert D. Rosenthal, our Chairman, CEO, and Chief Investment Officer, Edward Pileski, Senior Vice President of Wealth Management, and Philip Malikoff, Senior Vice President of Wealth Management and Director of Research. Additionally, other members are on hand if there are any questions where we need them. As always, before we begin the main presentation, I'm going to cover a few quick logistical items. All participants are in listen-only mode. Number two, after the team delivers their presentation, we will have time for Q&A. You do not need to wait until the end to submit your questions. Please feel free to submit them as we go. At this point, everyone should see a slide entitled Today's Speakers. If you don't, please post something in the Q&A window and one of us will try to help you. And finally, our general counsel always asks that I remind you that today's session may discuss the performance of some strategies and that past performance is not a guarantee of future results. In addition, given today's topics, it is important to note that anything discussed on this call should not be considered medical advice. With that, I will hand it over to Bob.
Thank you, Karen. First, we'll cover our agenda, which is an update on the COVID-19 pandemic, our current view of the economic recovery, areas to watch, which we continue to call our wall of worry, the FLI investment approach in this environment, a summary, and then we will have a Q&A session. Next page, please. As you know, we always try and find a quote that gives us some direction. This one from Carlos Slim Helu, with a good perspective on history, we can have a better understanding of the past and present, and thus a clearer vision of the future. As always, we rely very much on earnings. We have low interest rates. We continue to focus on quality companies, quality bonds, quality real estate, and we always have a long-term focus. So with that perspective historically, where we've done fairly well, and we're doing well currently, we believe we can have a fairly clear vision of the future as long as we adhere to those principles. Next slide, please. Foremost on everybody's minds is where we are on the COVID-19 pandemic. And this slide is designed to show you that the vaccination rate is way up, as you can see that blue line, and yet the infection rate had dropped precipitously, and then with the Delta variant started to rise again, as represented by the red line. A lot of that increase, or virtually all of that increase, is the result of the Delta variant and people who are not vaccinated contracting the virus. 64% of the US 12 years or older are fully vaccinated, and 75% have received at least one dose. The Pfizer vaccine has been granted full FDA approval. Moderna and J&J currently have the emergency use authorization, but we believe are very close to getting FDA full approval. Limited administration of booster shots has begun, and the FDA yesterday cleared Pfizer to begin giving a booster or a third dose to those 65 and older and those who are immunocompromised. The economic reopening throughout the country is with varying guidelines and rules for entry and mask wearing. So despite the fact that we've made a great deal of progress, as you can see by the blue line, we are still in various parts of the country dealing with mask wearing and other rules of social distancing and restrictions on international travel, et cetera. But things are getting better, but we still have to be very cautious. Next slide, please. Now this slide is designed to show you how we're comparing versus other countries in the world. Total vaccine doses administered per 100 people. And really, I believe it's the red line is the United States, which is middle of the pack. And China, if we can believe the numbers out of China, United Kingdom, France, and Germany have actually accomplished a better number of doses per 100 than we have. So the United States, although doing well, could be doing even better. And that's critically important towards getting to a full reopening, a full economic rebound, and getting people to work. Next slide, please. One of the factors that's influencing the stock markets, bond markets, real estate markets is the money supply. This is part of the economic reopening. Here, significant liquidity growth from the Fed and our federal government to fight the impact of the pandemic has been very positive for financial assets. This is a huge increase in monetary supply from the beginning of 2019. And with low interest rates and lots of liquidity in the system, it's contributing to some of the increases in the equity markets that we have seen. This is a positive for financial assets. Next slide, please. Consumer confidence is something that we should always focus on. Now, this slide depicts how we're doing from a consumer confidence standpoint, and it goes back to year 2000. And the gray shaded areas represent areas of recession. And you can see we had one in 01 and 02, of course, the financial decession of 08 and 09, and then the sliver right after 2020 is what we experienced over a year ago when the pandemic hit. The good news is that the recent consumer confidence numbers have improved from the drop when the pandemic first hit, as evidenced by the squiggly line that was well below where it had been prior to the COVID impact. But recently it's dipped down because of the impact of the Delta variant and some inflation concerns. But it's still well above pandemic lows. And we don't foresee a recession. So we hope that this number reflecting consumer confidence continues to build as we defeat the pandemic, as booster shots are being given, and most importantly, as more of the population that is not vaccinated becomes vaccinated. Next slide, please. Employment is a key factor in the economic rebound. And here you can see the rate is down. The number of employed is getting better, but we're still not at pre-COVID levels. And the Fed is watching this very closely. So if you look to the left side of the chart, which reflects the period of time just prior to the real hit of the pandemic, you can see that the number of people employed in the US is higher, still higher than where we are today. Now, of course, when you look at the numbers for April and May of 2020, you see a precipitous drop as the country shut down. And then you can see a build of employment, a slow but sure build through August of 2021, which is good news. But again, if you compare the extreme right of the graph to the extreme left of the graph, you see that we still have many millions of people not employed. This is something that's watched very carefully by the Fed and one of the significant reasons for the Fed remaining extremely accommodative. Next slide, please. Now, areas to watch as it relates to employment is the US civilian labor force participation rate, which reflects what the prior slide showed, that despite the fact that we've had a significant economic rebound, despite the fact that more and more people are vaccinated, we still have a participation rate that is suffering. As you can see, prior to the pandemic, we were between 63 and 63.5% of the population being employed. We're now down between 61.5 and 62. Yet at the same time, The chart on the right shows total job openings that are available, and you can see the significant growth there. So I'm sure you've heard that many employers are looking for employees, and that's reflected by the job openings. But the chart on the left shows that we're still lagging in terms of the participation rate. And there are a number of reasons for this. One could be, although it's not the only reason, that the very generous unemployment benefits that were granted by both state and federal governments sort of incentivize people not to work. Those federal unemployment benefits have run out this month in September. So we should start to see the participation rate improve and the number of job openings hopefully go down a bit as we bring more into the workforce. Next slide, please. Another very important aspect of the economy and economic growth is housing. And again, we have shaded this graph to reflect recessions. And of course, the very deep decession, close to a depression in 2008 and 2009. And as you can see, most recently, if you look to the extreme right, the S&P Case-Shiller National Home Price Index has actually hit a new high. So the pricing for homes has increased significantly, reflecting liquidity in the system and also reflecting a tight inventory of homes. But nevertheless, more homes are being built, prices are high, people feel as if they're accumulating wealth because of it, and this is a strong point for the economy. Next slide. Key to the economy growing and key to the performance of our assets is the underlying need to have real GDP growth. And this very interesting chart shows that prior to the COVID pandemic, the economy was growing at 2.4, 3.2, 2.8, 1.9, and then the bottom fell out as the pandemic hit. And we, in effect, had a recession, and GDP growth dropped by 5%, 31%, and then only to rebound significantly based on bipartisan government action out of Washington and the Fed, so that GDP grew by 33.8% in the September 20 quarter of last year and continues to grow through this year, 4.5%, 6.3%, 6.6%, and those are actual numbers. And then we're forecasting, or our outside economists, strategic research partners, are forecasting that the economy will continue to grow this year between 4% and 4.5%. And then into next year, we also see economic growth. So even though we've had that very strong rebound, growth is moderating, but we're still projected to have decent growth in 2022. And there's no recession forecasted at this point. And that's critically important to our desire to remain fully invested, although maintaining a buffer of cash, because the economy is strong, interest rates remain low. And to some extent, the economic growth that you see on this page and what's projected is restricted by some of the supply chain shortages that we'll discuss a little bit later. But nevertheless, the growth outlook for the economy appears to be reasonably good going into 2023 and 2022 and perhaps the beginning of 2023. Next slide, please. If you've listened to our webinars in the past, if you've read our quarterly letters for years and years and years and years since the inception of the firm, you know that we're very earnings driven. And this is a very key chart because it demonstrates what S&P earnings and S&P 500 earnings have been and what they're forecasted to be. So when people say the stock market's very high, does it belong being this high? Does it deserve where it is today? We say, let's look at earnings as one factor. And you can see in 2019, prior to the pandemic, S&P earnings were $160. As you can see in 2020, it dipped precipitously based on the pandemic and then started to recover at $137. This year is forecasted to be at least about $200, and forecasting for next year is over or about $218 to $220. Now, one thing that the projection for next year does not include is any modest adjustment for an increase in corporate taxes, which is being debated in Washington right now. But it's very important to show this trend of 160 to 137 to 199 to 218. And there are some other outside economists that we use that would suggest that the S&P earnings projection for 2021 and 22 are somewhat understated on this chart. But for our purposes, we're using this to demonstrate that the economy is strong and that the earnings from corporate America are robust, and actually profit margins have actually improved. And that's part of the reason why we see an increase in earnings. And as you know, we always believe that earnings and interest rates, good earnings and low interest rates, drive our share prices. So we're quite comfortable with this forecast for corporate earnings and the reopening of the economy. Next page, please. Now, having shown you strong consumer confidence, a strong employment picture, good GDP growth, good earnings growth at record levels, being invested has really paid off. The liquidity that we talked about earlier has also contributed to this. So if we just look at the year-to-date numbers, the NASDAQ is up at roughly 17%, and this week has been somewhat volatile. So this is as of the end of last week. I believe yesterday and today, we have made up what we lost on Monday of this week. But nevertheless, through Friday, we were up 17.3% in the NASDAQ. The S&P was up 19.3%, and the Dow Jones Industrial Average was up almost 15%. And if you look at the percentage from the lows of last year to the end of last year, you can see there were dramatic increases as well. Again, we think that those increases in those respective indices are based on the excess liquidity, the strong earnings, low interest rates. So being invested while still maintaining a prudent asset allocation, while still maintaining a little bit of a buffer of cash for volatility, our clients have done very well, and the general markets have done very well. And with that, my pleasure to turn it over to Ed.
Thanks, Bob. I'm now going to spend and take some time to go through some of the areas we are watching as they are causing some concern for many investors. And certainly the ongoing COVID pandemic and the emergence of the Delta variant and possibly others. Bob talked about COVID, so I'm not going to spend too much time here, but certainly the fast spreading COVID Delta variant has led to a new surge in infections and has slowed the pace of the global economic recovery. All this and what is next to come with this virus is definitely on everyone's minds. Other areas to watch are the implication of government actions as it pertains to the size of spending relating to the Infrastructure and Reconciliation Bill. President Biden's initial infrastructure plan, you may recall, was for more than about $4 trillion in investment for a wide variety of initiatives, ranging from building roads and bridges, climate proposals, to offering subsidized childcare, all of which were bundled together under the broad definition of infrastructure. Due to strong opposition, the expansive proposal was separated into two legislative measures, with the infrastructure bill limited to physical infrastructure projects, while the reconciliation bill would focus on climate and social programs. Last month, the U.S. Senate passed the bipartisan $1.2 trillion infrastructure bill. The bipartisan bill now heads to the House for approval. So to recap, congressional Democrats' two-track legislative strategies is to enact much of President Biden's economic agenda through the passage of the $1.2 trillion infrastructure bill, followed by the passage of the $3.5 trillion social and spending bill, the reconciliation bill. And the reason why it's called that is due to Senate Democrats attempting to advance the legislation through a budget strategy called reconciliation. This is where it's a special process that makes certain spending legislation easier to pass in the Senate, as it doesn't require obtaining that 60 vote threshold. But Democratic leaders have tied these bills together to ensure that the necessary support is achieved for both measures. So moderates such as Senator Manchin's influence on the legislative process will determine the scale and the timing of the reconciliation bill. So more to come on that. And obviously another area which has been on the news front this week is the shutdown and the possibility there. The U.S. House yesterday has approved a bill to suspend the debt limit and fund the government on a bill avoiding a partial government shutdown. The legislation would provide temporary funds to keep the federal government running past the current September 30th deadline. It would also suspend the debt limit through 2022. Now, despite clearing the House, a major showdown is brewing in the Senate. The standoff exists because Republicans are not likely to help Democrats raise the debt ceiling, while Democrats are attempting to pass that $3.5 trillion reconciliation bill through via a simple majority vote. So Democrats are probably unlikely to move the debt ceiling without Republican support, which possibly will lead to a potential shutdown and default, which would certainly negatively impact the market and U.S. economic growth. Another area we're watching is the deficit and debt levels. Sovereign deficit and debt levels across the developed economies are at historic levels due to massive fiscal spending amid the COVID pandemic. While the speed and magnitude of the fiscal response over the past year has helped prevent a deeper global economic downturn, there is an increasing concern that the rising debt and a widening deficit could have negative long-term consequences. Certainly the focus on geopolitical risks, what has happened in Afghanistan is a concern, and certainly what's going on in China. China's government crackdown on technology firms has led to increased regulatory action on companies such as Alibaba, for example, as the government attempts to change the way in which these companies conduct their business practices. Next up is Fed monetary policy, which was certainly in the news yesterday. The Federal Reserve signaled it could start reversing its pandemic stimulus programs and scaling back asset purchases in November and complete the process by mid-2022. So possible tapering could begin at that point in time, November or in their December meeting. Fed Reserve Chair Jerome Powell stated that the tapering was not meant, and I think this is key, to be a direct signal on the timing of the interest rate liftoff. Fed projections show officials evenly divided on a 2022 rate hike. Another area to watch has been the supply chain challenges. The Delta variant has continued to cause supply chain disruptions, resulting in shortages and rising prices. And the last is Chinese real estate turmoil. On Monday, the market was negatively impacted because of a potential default by a Chinese property developer, Evergrande, which led to that decline. There were concerns as to whether this would be a spillover effect on the China's leveraged real estate market. Certainly, S&P Global Ratings on Monday said a default by Evergrande would certainly cause some ripples in financial markets, but would be unlikely to lead to a tidal wave of defaults. The market seemed to digest that volatility on Monday and basically citing that the Chinese authorities would ultimately provide a backstop. So that news story has since been calm a bit. Now, let's go to the next slide and take a deeper look at some of these areas we're watching. So certainly government actions and tax increases is on many investors' minds. The potential for corporate tax increases and individual tax increases is a reality. There's a lot still to be determined. Last week, Democrats plan to pay for the new spending by raising taxes on corporations and high-income households. Although, again, specifics have yet to be agreed upon. House Democrats recently outlined tax increases to offset the $3.5 trillion spending bill. The Democratic House proposal would increase the corporate tax to 26.5% from 21% and restore the top individual rate to 39.6% from 35%. Also, areas to watch are certainly increases to capital gains tax rates and dividend rates. In the House Democrats' proposal, a top 25% federal tax rate on capital gains and dividends is something they're trying to get. It would apply to single taxpayers with over 400,000 of income and married couples with over 450,000. Estate tax changes. The House Democrats' plan would reverse the doubling of the estate and gift tax exemption that Congress passed in 2017. That increase would end after 2021 instead of expiring at the end of 2025. The exclusion would likely fall to around $6 million per individual from 11.7 million. Estates surpassing that threshold would be subject to the federal estate tax, which has a top rate of 40%. And the last is the elimination of the step-up in basis. For now, House Democrats did not include the Biden administration's proposed change to the stepped-up basis method of evaluating assets. This is a tax provision that allows for adjusting the asset's purchase price to the value on the date of death. Further debate will determine a great deal. I think it's important to note that all of this is still to be worked out in Congress. Once a decision comes to in Washington, we will be sure to digest the implications of what is passed for with regard to our clients and obviously discuss that with you. There's also a debate as to what would be the effective date of any of these changes. And that is something, again, that is to be played out. So this too will impact investors. Next slide, please. So areas to watch, diving into the Federal Reserve interest rates, and this is certainly a topic that was certainly relevant today. The Fed has signaled that rate rises are possible next year. The dot plot, which this chart shows the projections which map out basically each of the 18 Fed members' expectations for where rates will be in coming years, suggests that the central bank is pulling forward its forecast for 25 basis point rate hikes. So it's been a quite, they've been in agreement for the most part. In the last round of projections released in June, the Fed saw no rate hikes through the end of 2022, but 2 rate hikes in 2023. So those increase in rates are being pulled forward a bit. New projections, again, released yesterday, as it pertains to 2022, they were divided. It showed half of the 18 officials expect to raise interest rates by the end of 2022, while the Fed projects 3 interest rate hikes in 2023 and 3 more in 2024, bringing the benchmark interest rate to about 1.8% at the end of that period. Either way, there is not likely that a rate increase will come until at least late in 2022. Next slide, please. Tapering is something that the Fed has been doing since June of 2023. In March of 2020 is when also the stimulus started, which was the height of the pandemic. When the pandemic began to negatively impact the US economy in early 2020, the Fed stepped in, cutting its short-term benchmark rate to near zero and providing additional stimulus. The Fed committed to buy 120 billion worth of Treasury and mortgage-backed securities every month to keep long-term interest rates low, provide liquidity to the markets, and spur demand. These purchases will be rolled back soon, which is referred to as tapering. The Fed officials yesterday sent a strong signal via a unanimous vote. It's closer to tapering its bond buying program. They'll have two opportunities to do it this year. Early November and December are the two meetings. Monetary policy will indeed remain accommodative, but yesterday's Fed statement strongly signaled a QE taper will likely occur at the November meeting, and probably tapering will likely be finished by the middle of next year. So I think you got to give credit to the Fed for stepping in when they did with regard to tapering, stabilizing the economy, and also stabilizing the market, but also providing some clarity through their messaging as to what path they're on or taking. The Fed officials, this was a unanimous vote, by the way, with regard to tapering, that they're going to end the bond buying program before they start raising rates. So, so the Fed also insisted that the timing of the tapering is not a direct signal on the timing of the rate liftoff. So that's also, again, another clear message to the market to try to map out the path that they're on. Next slide, please. Obviously, you could see here the inflation, the core consumer price index spiked a great deal. And this is due to the, in 2020 and 21, this is due to the significant amount of stimulus provided in response to the pandemic. And with the strong pace of the US economic reopening, inflation has been on the rise. Inflation has risen this year with core prices. This is core prices that exclude volatile food and energy categories was up 3.6 in July from a year earlier. The Fed Chair Powell believes that the recent inflation surge is mostly due to temporary factors and is transitory due to mainly shortages of supply. So yesterday, Fed officials revised their expectations on inflation higher, and its statement described inflation as elevated. So that's something new that appeared in their documentations, the word elevated. Although the Fed still believes that rising pressures, again, is transitory, the median Fed member raised their forecast on the PCE inflation to about 4.2% this year. That's compared to about 3.4 in June. So the key takeaway is that the Fed's expectation to raise interest rates earlier certainly coincides with higher expectations on inflation. Next slide, please. The federal deficit is obviously something that has peaked. You can see here that the US federal deficit peaked in March of this year, hitting around 4 trillion deficit. And you can see the upswing in 2021. And this has since, the federal deficit has since declined by more than about 1.2 trillion in the past 4 months. So why is that? It's primarily due to strong tax revenue growth, 14% plus year over year tax revenue growth has certainly helped that. And while emergency spending has been rolling off, the Labor Department spending declined largely due to a drop in unemployment insurance as more Americans found jobs and states phased out their expanded unemployment benefits. You'll recall that the CARES Act, enacted in March of 2020, expanded the unemployment insurance system to provide relief to those who are out of work. And those benefits have mostly now expired. So that's what accounts for that improvement in the federal deficit. Another area to watch on the next slide is the national debt, which has obviously also gone up. The increasing level of U.S. debt is concerning, but manageable in the short to immediate term, given our expectations that rates will only rise modestly as the economy improves. However, longer term, this burden of debt is a concern as policymakers, and will certainly need to address the challenges through a combination of reduced spending and increased revenue in order to reduce the U.S. debt. Next slide, please. The last area to watch before I pass it over to Phil is supply chain disruptions. You could certainly see here that via the S&P transcript analyzer, this is the amount of times that the word shortages is appearing within those transcripts has certainly increased over time, whether on a monthly basis or a rolling 3-month period. There's been a great deal of shortages that has caused disruptions in the supply chains. Again, the COVID pandemic has led to a global supply issues, such as delays in getting merchandise in stores, and again, resulting in rising prices. So factories manufacturing the goods have experienced work shutdowns because of the pandemic. Rising freight costs have reached historically high levels. Bottlenecks have been more severe than anticipated, and new waves of COVID-19 cases around the world due to the Delta variant, along with uneven vaccine distribution, has threatened to disrupt supply chains for longer than would have hoped. So that's certainly going to be an issue for the remainder of the year. I know this seems a lot, but as prudent wealth managers, it's important that we keep an eye on a wide range of areas that could impact investors. I will now turn it over to my colleague, Phil Malkoff, to take you through our investment approach in light of the economic positives Bob discussed, as well as the areas to watch that I just went over. Phil?
Thanks, Ed. So there, as we've seen, there are absolutely no lack of headlines to worry about right now. Bob talked about COVID and the Delta variant, moderating economic growth. Ed talked about potential tax changes, the Fed taper, the debt ceiling, Chinese government regulations, and inflation. Those are just some. But there are always many concerns in the marketplace. The issues and headlines may change, but the fact that there are many concerns does not. And this slide shows our investment approach to handle those concerns, no matter what they may be. We look at the investing world in 4 different baskets: security investments, defensive strategies, traditional equities, and private investments. And as we move to the right on the chart, potential returns and risk levels increase. We do recommend that most, not all, but most clients have exposure to each of these baskets, but how much is dependent on your individual investment goals, liquidity needs, timeframes, and risk tolerances, amongst other factors. So let's start on the left with security. This is comprised of cash and fixed income or bonds. While we do recommend that most clients remain underweight this basket, we also want to make sure that everyone is comfortable, can sleep at night, and not worry when the market goes through a rough period. So we do recommend that clients who are particularly risk averse or have large or upcoming liquidity needs keep some cash on the sidelines. We are available to discuss your individual situation and determine what the appropriate level would be for you. Bond yields, as we will discuss shortly, remain low and relatively unattractive, hence the reason for our underweight to this basket. We have 3 strategies in our defensive strategies basket, each designed to produce positive returns when the equity markets are appreciating, but more importantly, to protect capital when they are not. This doesn't mean that these strategies will appreciate in the down market, but they are designed and are actively managed so that losses would be lessened and volatility dampened. This is called having good downside capture, and it should reduce losses during down periods. From a very, very high level, we recommend that clients have an overweight allocation to this basket. Traditional equities is very simply owning equities without any hedges or other loss reduction techniques. We focus on high quality, market leading, attractively valued companies to include in our portfolios and maintain very concentrated portfolios as we want our best ideas to have considerable weightings in order to make meaningful contributions to performance. We don't believe in diversification or diversifying away from our most interesting opportunities. It is our recommendation that most clients be modestly underweight equities. Private investments, which include real estate, private equity, real assets, and collectibles, should be utilized on an ad hoc basis and as appropriate. Of course, each client is different, and we customize individual asset allocations for each of our clients based on many factors. We are continuously monitoring the investment, economic, and political landscapes, as well as each of our clients' individual situations in order to determine whether any changes should be made to their allocations. So let's move to the next slide, which is fixed income. So as I mentioned previously, bond yields remain low and relatively unattractive, which we can see on this chart. I should start by reminding you that we only invest in high quality investment grade bonds. Bonds are in our security basket, so this is not the place that we want to chase yield by investing in junk bonds or low quality securities. With inflation readings of about 4%, at least temporarily, high quality bonds don't yield anywhere close to inflation. A 3-month T-bill yields just a few basis points, while 5 and 10-year treasuries and 5-year munis are under 1% on a tax-effective basis. Corporate bonds with 5-year maturities are also under 1% for taxable accounts and just over 1% in non-taxable accounts. These rates are well below historical levels, and it's for this reason that we are allocating away from fixed income and towards our defensive strategy basket. Go to the next slide. Dividend growth. So one of our key strategies in the defensive strategies basket is FLI dividend growth. This strategy is predicated on the Gordon growth model, which surmises that the expected return of a stock is essentially equal to the dividend yield plus the sustainable growth of its dividend. You can see on the bar chart on the right of this page that over the past 5 years, dividend growth portfolio has yielded 2.9%, and its dividend growth rate has been 9.2%, giving it an expected return of 12.2%. The strategy's actual net performance, which is after fees, is 13.2%, actually bettering the Gordon growth model's expected return. Dividend growth portfolio is comprised of high dividend paying companies, which have a culture of not just paying, but consistently raising their dividends. This provides stability to their stock price and possibly appreciation during periods of economic uncertainty. Last year, one of the definitive periods of uncertainty, the strategy grew its dividends paid by 5.2%, while the S&P 500 didn't grow their dividends at all. During this period of economic uncertainty, the strategy advanced strongly. One final thought, and Ed kind of touched on this about dividend growth, but currently tax rates are very favorable to dividend income, but that could change given proposed tax legislation being discussed in Congress. Let's go to the next slide. Okay, equity markets and rising rates. So we've discussed that interest rates are low, so one would assume that at some point they will rise. One would also assume that rising rates are not favorable for equity performance. However, that is not always the case, as we can see on this chart. The blue line shows the yield on the 10-year treasury going back to 1989, with the red arrows indicating periods where yields on the 10-year went higher. There are 8 such periods, and in each of these periods, the annualized return has been positive, with 7 of them producing double-digit performance and 4 of them over 20% appreciation. As Mark Twain once said, while history doesn't always repeat itself, it does rhyme. And as such, we would expect similar results in the future. Next slide, please. So in conversations with clients, I'm frequently asked, where are we seeing opportunities in the equity markets? The simple answer is that we are looking to identify great secular growth companies for our growth strategies and inexpensively valued companies for our value strategies. These companies tend to be high quality, companies taking market share and growing businesses, companies both broadening and lengthening their revenue runways, companies with high recurring sales, companies with strong management teams, clean balance sheets, and trading at attractive valuations. Not so easy to find, but we've identified some areas. And while we're not thematic investors, there are areas that we're drawn to. E-commerce is one, and the global pandemic has hastened the transition from bricks and mortar retailers to online sales. Amazon.com has certainly been a beneficiary of this transition, as has Nike, which is seeing its DTC or direct-to-consumer business skyrocket. Traditional retailers such as Williams-Sonoma and Lowe's have become omni-channel as they are making online sales a more important part of their business models. Cloud computing and SaaS, an acronym for software as a service, have also seen tremendous growth during the pandemic. Microsoft, Amazon.com, and Alphabet, which is the parent company of Google, have seen and should continue to realize strong earnings growth as companies store their data in the cloud. Adobe Systems and Intuit are two examples of SaaS companies which have revamped their business models and seen tremendous earnings growth. While the world has been moving away from cash and checks as a medium of exchange to digital or electronic payments for many years, the global pandemic has accelerated that change. MasterCard, Visa, and PayPal are beneficiaries of this ongoing transition. During the pandemic, we have witnessed the importance of pharmaceutical, biotech, and medical companies, and the human race is depending on these companies to develop treatments and solutions. But even before COVID-19 entered our vernacular, these companies were exploring new technologies to improve healthcare efficiencies as our aging population strained healthcare budgets. Companies such as Abbott Labs, Intuitive Surgical, and J&J, Johnson & Johnson, are important contributors to these efforts. Other areas of focus include 5G technology, which will alter the way we utilize mobility in the future. And American Tower and Qualcomm are important companies in this space. Social media, which has become an important way for companies to reach their target markets, and online search, which is also an important advertising option, are also seeing strong growth. And Facebook and Alphabet have benefited from these ongoing trends. And as discussed earlier, we also focus on companies that are dividend growers. A dividend grower is a company which has a corporate culture of not just paying a dividend for many, many years, but for each and every one of those years, actually increasing the amount of the dividend that they pay. For a company to do so, must have consistent earnings growth, a strong balance sheet, and a desire to be shareholder friendly. These are qualities that we find attractive in companies which we want to own for long periods of time. Companies such as Comcast, Home Depot, and UPS exhibit these traits. Let's move on to the next slide, please. So earlier I mentioned that bond yields are just not very attractive, at least on a relative basis. Here is a visual depiction of that. The earnings yield versus the bond yield, or what we refer to as the EYBY, is one of the tools that we use to assist us in determining how to allocate assets across baskets. This chart shows that the earnings yield for the S&P 500, which is the blue line, plotted against the yield on the 10-year Treasury, the red line. The S&P earnings yield is calculated by taking the reciprocal of the price to earnings ratio, and the yield for the S&P 500, the earnings yield, is about 4%, while the bond is yielding about 1.4%. On a comparative basis, stocks are just much more attractive than bonds, hence our asset allocation recommendations. Let's go on to the next slide. So this slide talks about timing of the market. So one thing that we've learned over our nearly 38-year history is that it's very, very hard to time the markets. And this chart confirms that. As an investor, if you were fully invested in the S&P 500 index from January 1st, 1995 through the end of August, your annual return was 9%. However, if you were out of the market for only the 5 best performing days over that more than 25-year period, your return drops by nearly 2% to 7.1%. And you can see how it goes lower from there. Additionally, it's very important to remember that these returns compound over time, so that missing out on that nearly 2% return in 1 year compounds to over 45% in 20 years. We prefer to rely on a disciplined approach to asset allocation based on each individual or family's financial goals to help weather periods of uncertainty. Ultimately, it's our thought that economic, market, and company fundamentals will determine the direction of investments, and short-term periods of volatility are part of investing. We believe that it's time spent in the market that's rewarded, not timing the market. Let's move on, please. So you can see on this graph that since the end of 2007, equity indexes have appreciated quite considerably, with some significantly outperforming others. At the top of the list, showing nearly 500% appreciation, is the Russell 1000 Growth Index. Growth investments tend to outperform value style investments when the economy is grinding along, growing, but at a modest pace, combined with low inflation and low interest rates. And this has been the case for the vast majority of this time frame. Value investments, which show nearly 200% appreciation in this time frame, tend to outperform when the economy is coming out of a recession and beginning to accelerate. That was the case last fall and into this spring. The bottom two lines, which are basically on top of each other, are both international indexes. International has trailed domestic investments over the past 10 plus years. We have remained underweighted, and some would say significantly underweighted, international investments during this period, and will continue to do so until we see signs that they will outperform US-based equities. So this chart is what we call the money mountain, and it shows how money market assets or cash has grown since 1990, when it was about 500 billion. Over the years, money market cash has risen in times of fear and subsequently fallen as market sentiment becomes more favorable. The chart shows that assets rose in 2000 and 2002, and again from 2007 to 2009. And as we saw earlier, those were recessionary periods. Earlier last year, before the pandemic, there was about 3.6 trillion in money market assets. That quickly rose over a 9-week period as fear about the global pandemic increased, reaching 4.8 trillion, as we can see in the red circle. It is important to mention that money market funds are currently paying very little, if any, interest. So investors have parked $1.2 trillion of cash, more than during the financial crisis in 2007, 8, and 9, in money markets, which yield essentially zero rather than other asset classes. We view this as a positive and believe this is a contrarian indicator. In the past, the peaks or accumulated cash have been reinvested back into equity investments, and we did see a bit of this earlier this year as the line hooked lower before going up a bit. During the financial crisis, money market assets rose from under $2 trillion to almost $4 trillion in 2009. 3 years later, it was down to about $2.5 trillion. We believe that eventually much of the cash currently parked in money markets will find its way back into the equity markets as fear of the global pandemic recedes and investors believe that the global economy will return to normal. I will now turn it back over to Bob to summarize our presentation.
Thanks, Phil, and thanks, Ed, for those presentations. You know, in summary, the COVID-19 pandemic has waned for those who are vaccinated. Those who are not are very susceptible to the Delta variant. Vaccinations must continue globally. And as this battle goes forward to get people vaccinated, the economies, both domestically and internationally, will improve. The US equity markets are strong despite the pandemic, and earnings are expected to grow into 2022 and possibly beyond, although not as robustly as this year. Unemployment has been on a steady decline, but still has a way to go in order to reach pre-crisis levels, and certain industries are still struggling where they have not been able to get enough workers. That too should improve as the vaccination process goes forward. Swift and bold bipartisan federal action was taken to offset the economic impacts of COVID throughout 2020 and thus far in 2021. Further fiscal initiatives, traditional and social infrastructure, need to be worked out, and the debt, deficit, and inflationary impacts of these will need to be addressed in the future, and we are watching that very closely. And as was pointed out, there's quite a debate going on in Washington, given the very slim majority that the Democrats have in the House and virtually no majority in the Senate, with the exception of the vice president voting. It's very hard to work out any legislation. So it remains to be seen what will ultimately come out of Washington. We believe, next page, we believe being patient with a prudent asset allocation, as Phil said, that is overweighted to defensive strategies, which, as you can see, have done well, while underweighted to fixed income and traditional equities, is the best course for most investors, given the wall of worry that we see at this point. Maintaining enough cash and high quality short-term fixed income to sleep at night is important, but being primarily invested is the key to long-term asset growth. Just look at this week. On Monday, the markets were down, the S&P or the Dow was down 650 points because of something that happened in China. And then out of the clear blue, the last 2 days, the markets have improved dramatically, again, reflecting low interest rates and stronger earnings growth. So to Phil's point, it's very hard to have a crystal ball to predict that. Concentrated portfolios of companies with strong fundamentals and managed with a focus on quality and secular growth trends and or growing dividends should prove successful over the long term as they have in the past, which goes back to our initial quote of looking at history, looking at the present, what has worked, why has it worked. We think that will continue to be what makes things go up in the future. Reviewing your overall wealth management plan with an eye towards understanding the tax, charitable, estate planning, and insurance options is a critical step and one we can help with in conjunction with your accounting and legal professionals. And with that, I'll turn it over to Karen for Q&A.
Thanks, Bob, and thank you all for that great presentation. We're nearing the top of the hour here, so we'll keep this probably a little bit brief, but we do have time for a couple of questions. Let's start with the following. That you discussed the supply chain disruptions. How do we think that will affect the economy and our stocks, or, earnings in general?
Karen, I'll take that. There's good news and bad news. The bad news is there are supply shortages right now. The good news is that reflects good demand. There's demand, and therefore there are shortages. So we had a client come into the office yesterday who said he was looking to buy a particular car and was told by the dealer, come back in 2 years. So there's pent-up demand, as evidenced by the money mountain that was referenced, the consumer confidence that is improving, and the delay to some extent that certain companies have in getting product will just help to grow their backlog, and that should be satisfied in the future. So I think we view it as a deferral of potential good business once the supply chain works out. And whether it's chips that you've heard about with cars, or it's product stuck on the West Coast in the West Coast ports, hopefully they are transitory, and that we'll see the evidence of the supply chain improving in future sales and earnings for the companies that we invest in. But meanwhile, despite those shortages, the companies that we've invested in for you have demonstrated significant earnings growth for the most part during this year. And the guidance that we're seeing from them is very promising.
Great. I think we have time for one more. With the market performing so well already in 2021, how are you positioning portfolios and strategies for the rest of the year amid the risks and concerns?
I'll take that. I think it goes back to the overall asset allocation, which I went through. But within each of our strategies, we have some flexibility in how we position the portfolios. There are times it makes sense to be a little bit more aggressive. There are times it makes sense to be a little bit more conservative, be a little more defensive, maybe raise cash levels a little bit. So, those are the types of conversations we're having within our subcommittees. So each strategy has a subcommittee of the investment committee that meets with the portfolio manager and determines, the holdings and how aggressive to be. So those are ongoing conversations that we're having. And in certain instances, we have gotten a bit more defensive. In others, we've discussed it, and it probably happens soon.
Thank you. All right. Well, on behalf of the entire team at FLI, I want to thank everyone for joining us. We hope you found the session interesting and insightful. If you have any friends or colleagues who you think would benefit from joining a future event like this, please let us know and we'd be happy to include them. For our clients on the line, we just want to remind you that our investment committee is always available to discuss your individual asset allocation. Just give us a call. We hope to be able to see all of you in person again soon. In the meantime, please know we are completely available. We can do an in-person, Zoom, or phone meeting. We wish you continued good health and ask that you please continue to do your part and practice social distancing. We hope everybody has a wonderful rest of the day.
Thanks a lot, everybody.